Breaking. China just pulled the financial plug on America. No warning, no negotiations, no mercy. In a move that has shocked Wall Street and stunned global markets, China has frozen all investments into the United States, effective immediately.
If it persists in disregarding the common interests of both countries and the international community and insists on escalating the trade and tariff conflict, China will, as always, fight to the end.
The directive is coming straight from Beijing's highest financial authority, China's State Administration of Foreign Exchange. Apple, Tesla, Qualcomm. No one is safe. As China slaps a 34% tariff on American imports, from agricultural products to semiconductors, the fallout is global and just getting started. China once had nearly $1 trillion invested in the United States, propping up everything from Hollywood blockbusters to Wall Street giants. But now, it's pulling the plug. Quietly. Completely. What we're witnessing may be the first shot in a new kind of financial war, not fought with bullets or sanctions, but with capital flight, liquidity shocks, and silent exits through the back door. And here's the kicker. What if America's allies are next to bail? Let's unpack it all, right after you hit that subscribe button. In March 2025, something big happened, but very quietly. China's Ministry of Commerce and its main foreign exchange office decided to stop sending money to countries it now sees as hostile. One of those countries is the United States. There was no big press release or official statement. Instead, the information came from a leaked document, and later, Reuters confirmed it was true. This sudden decision by China is now shaking up the entire global economy. Let's be clear, this is not a small step. It's a massive move. Chinese investment in the U.S. was already dropping for years. Back in 2016, China invested around $46 billion into American businesses. By 2023, that number had fallen to just $2.3 billion. And now, it's zero. China has turned off the money tap completely. That's more than just a warning. It's a clear signal that China is no longer playing by the old rules. Why does this matter so much? Because when a country invests in another, it means more than just money. It means trust. It means cooperation. It means sharing in each other's growth. So when one of the two biggest economies in the world suddenly cuts off money to the other, it tells us something serious is going on. And this doesn't just hurt America, it affects the whole world. Now the big question is, was this a quick reaction to worsening U.S. China relations? Or is it part of a much bigger plan by China? If it's a plan, then we must ask, what is China trying to build instead? First, let's understand just how deep this freeze is. China has always been careful about how it sends money abroad. But this new move is extreme. It tells Chinese companies, both private and government-owned, not to invest in American businesses at all. That means no more buying U.S. tech companies, no more buying Hollywood studios, and no more Chinese companies putting money into American real estate. In short, China is pulling away from America's economy completely. And this affects more than just America. Many other countries, including in Europe and Asia, rely on Chinese money to help grow their own businesses. Now they're worried they could be the next ones on China's hostile list. If that happens, they too could see Chinese investments disappear overnight. The global economy, already weak in many places, might suffer even more. There's another reason China may be doing this: to protect itself. By keeping its money inside its own borders, China avoids risks like U.S. sanctions or having its assets frozen in case of political conflict. But China isn't just hiding its money, it's also building something new. Over the past few years, China has been working on its own digital currency, the e-yuan, building its own banks to lend money around the world, and creating trade routes through the Belt and Road Initiative. These are not just business projects. They are parts of a new system that China wants to control. That's why this moment is so alarming. If China is truly building a separate financial system, one that avoids the US and the West, it could split the global economy into two sides. One side with the U.S. and its allies, the other with China and countries that depend on Chinese loans. This is more than economic competition. It's a financial Cold War. At the same time, the global financial situation is already unstable. Interest rates are high, countries are struggling with debt, and many are still recovering from the shocks of the COVID-19 pandemic. For years, Chinese investment helped many developing countries stay afloat. But if China now decides to stop or slow down those investments, weaker economies like Pakistan, Sri Lanka, and others may face fresh financial crises. China's leaders are also focusing more on strengthening their own economy from within. This strategy is called dual circulation, which means they want Chinese people to buy more local products and rely less on foreign trade. If that works, China will have even fewer reasons to send money abroad, unless it's for political reasons, not economic ones. China may now choose to invest only in countries that support it on the world stage. That creates a dangerous new world. Imagine a future where countries get investments based on how loyal they are to China or the U.S., not based on what makes business sense. That would turn global finance into a loyalty test. And once money stops flowing freely, trade might slow down too. Travel, technology, even education exchanges could start to break down. To truly grasp the magnitude of China's financial retreat and the threat it poses, it's essential to examine the hard numbers behind its investments in the United States. China is not just a trading partner or a distant rival. It has been deeply embedded in the very machinery of the U.S. financial system for decades. According to the U.S. Department of the Treasury, in 2023, China held about $870 billion worth of U.S. Treasury securities, a sharp drop from its peak of $1.3 trillion. But by the end of 2024, China had sold off an additional $110 billion in treasuries, accelerating a long-term trend. While Japan has now overtaken China as the largest foreign holder of U.S. debt, China's liquidation is far more alarming. Japan remains a traditional ally with closely aligned interests. China, on the other hand, is deliberately unwinding its financial exposure as part of a larger strategic recalibration, and that is no coincidence. These treasury holdings matter because they help finance the U.S. government's massive and growing deficits. The United States is running a fiscal deficit of around 6.5% of GDP as of early 2025, and its total federal debt is climbing past $36 trillion. Foreign investors, especially central banks, buy treasuries because they are considered safe, liquid, and reliable. But if China continues to offload them and others follow suit, the cost of borrowing could spike. Interest rates on U.S. government bonds would have to rise to attract new buyers, increasing the government's debt servicing costs and potentially triggering inflationary pressures. But treasuries are only part of the story. China's financial footprint in the U.S. spans multiple asset classes. But this shift poses a double-edged threat. On one hand, it weakens U.S. influence by denying it a crucial financial backer. On the other, it injects uncertainty into American markets that have long depended on Chinese capital. If Beijing starts dumping treasuries more aggressively or influences other countries to diversify away from the dollar, the global bond market could experience tremors. Already, countries like Brazil, the UAE, and even France have conducted small-scale energy or trade deals in Chinese yuan. The world is watching and following China's lead, cautiously but deliberately. And here's where things get even more concerning. The United States is losing its grip faster than many anticipated. U.S. Commerce Secretary Gina Raimondo openly admitted that America is losing leverage fast. Let that sink in. A senior U.S. official confirming that the dollar, once the undisputed king of global finance, is now vulnerable to strategic erosion. The silence from many other quarters of government only adds to the unease. Are we too late in recognizing the shift? Now here's the twist that should alarm every investor, policymaker, and citizen. China isn't retreating into isolation. It is building bridges. And not just with predictable partners like Russia. China's pivot is toward Riyadh, Moscow, and even Brussels. Yes, even within the European Union, nations are beginning to consider dual-track trade relationships. Some transactions in euros or yuan instead of dollars. Saudi Arabia, for instance, signed a yuan-based oil deal with China in late 2024, breaking a decades-old tradition of pricing oil exclusively in dollars. This isn't just symbolic, it's structural. The petrodollar system has underpinned American global power since the 1970s. If it fractures, the dollar loses one of its foundational pillars. This growing financial axis between Beijing, Moscow, and oil-rich Gulf nations is a formidable challenge. Russia, under Western sanctions, has long been pushed to find alternatives to the dollar. China's strategy offered them a lifeline. Together, they're developing alternative settlement systems and digital currencies that could sidestep the SWIFT network, which the West controls. In February 2025, Russia and China successfully conducted a major energy transaction in digital yuan, processed entirely outside the dollar-based system. That's no longer an experiment. That's a prototype for a post-dollar future. What makes this a siege, not just a standoff, is the methodical tightening. China isn't crashing out of global finance. It's laying siege to the dollar's dominance, brick by brick, alliance by alliance. The U.S. response has been fragmented at best. The Federal Reserve is entangled in internal debates over interest rates and inflation. And what of Europe? Surprisingly, there are cracks forming in the Western Bloc. While NATO remains firm militarily, financial unity is starting to fray. Germany and France, deeply reliant on Chinese trade, have been careful not to alienate Beijing. In fact, a secret memorandum leaked in January 2025 revealed that German central bankers were exploring yuan-denominated bond reserves, a potential hedge against dollar volatility. If Europe begins to hedge its bets, American influence could unravel faster than anyone anticipates. In 2024, foreign direct investment, FDI, into the United States shrank by a staggering 22%, a sharp break from the post-pandemic recovery years, where international capital had flowed into U.S. assets like a river into a thirsty valley. But the most jarring revelation is the forecast. Another 19% drop is expected in 2025. FDI is not just a financial number, it's oxygen. It funds innovation, builds infrastructure, and creates jobs. Its absence is now choking the lifeblood of many industries, from manufacturing to high-tech. Let's zoom into this capital retreat. One of the biggest red flags came when Norway's sovereign wealth fund, the world's largest at over $1.5 trillion in assets, quietly pulled out $7.1 billion from U.S. tech stocks. This is not a random portfolio adjustment. It's a seismic signal. Then came Japan's Government Pension Investment Fund, GPIF, the largest pension fund on Earth, slashing its exposure to American real estate by 30%. Real estate is considered a long-term bet, especially for conservative funds. When GPIF walks away, it means the risk calculus has changed drastically. The perception of U.S. markets as a safe haven is beginning to erode. This massive exodus of capital is creating dangerous knock-on effects. As foreign money pulls back, domestic firms are finding it harder to raise capital through traditional channels. The equity markets are volatile, and banks are becoming more conservative in their lending. To fill the gap, companies, especially those already carrying heavy debt loads, are turning to the one source left, which is private credit markets. So what happens when companies are borrowing at 11% just to keep the lights on? The answer is both simple and horrifying. They start bleeding from within. Already weakened by inflation and supply chain issues, companies are now being gutted by high interest payments. The least protected always suffer first. Mid-sized businesses, startups, and industrial firms with high operating costs. Layoffs become the easiest lever to pull. This means we are likely to see massive layoffs follow soon. So how does this affect the consumers? Tariffs now cover $500 billion plus of Chinese imports, up from $370 billion in 2020, with average rates hitting 22%. Prices of goods like appliances rose 16.7% year over year. Household costs are expected to climb $1,950 on average in 2025. However, real wages remain stagnant, while corporate profits are falling and inflation stays above the target level. U.S. economic uncertainty in the first quarter of 2025 is the highest in over a decade, worse than 2008 or 2020. So what does this all mean for the future? A divided financial world, skyrocketing debt, capital fleeing the U.S. at record speed. The question now isn't just how bad will it get, but what happens if China succeeds? And could we be watching the fall of the dollar's global empire in real time? Or is this the wake-up call America needs to rebuild its dominance from within? Either way, the ground is shifting, and fast. Subscribe now to stay ahead of the fallout. Because in this new financial war, the winners won't be the loudest. They'll be the best prepared.